In technical analysis, a trend line is a visual representation of the direction and strength of a price trend in a financial market. It is created by connecting a series of higher lows or lower highs, depending on whether the trend is bullish or bearish, respectively. Trend lines are commonly used by traders and analysts to identify and confirm the presence of a trend, as well as to make predictions about future price movements. Here are some key points to understand about trend lines in technical analysis. Bullish trend line. A bullish trend line is drawn by connecting a series of higher lows. It indicates an upward trend in prices and suggests that buyers are in control. Each time the price pulls back and bounces off the trend line, it reinforces the strength of the upward trend. Bearish trend line. A bearish trend line is drawn by connecting a series of lower highs. It indicates a downward trend in prices and suggests that sellers are in control. Each time the price rallies and fails to break above the trend line, it confirms the strength of the downward trend. Support and resistance. Trend lines can act as support or resistance levels, depending on the direction of the trend. In an uptrend, the trend line often acts as a support level, where buyers step in to prevent prices from falling below the trend line. In a downtrend, the trend line can act as a resistance level, where sellers emerge to prevent prices from rising above the trend line. Validating trend lines. To increase the reliability of a trend line, it is important to have multiple touches or confirmations. The more times the price interacts with the trend line, the stronger the trend is considered to be. Generally, at least 2 to 3 significant touches are required to establish a valid trend line. Trend line breakouts. Traders often look for breakouts, which occur when the price breaks above a bearish trend line or below a bullish trend line. These breakouts are seen as potential signals of a trend reversal or acceleration in the opposite direction. Traders may enter new positions or adjust existing positions based on trend line breakouts. Time frames. Trend lines can be drawn on various time frames, from intraday charts to long-term charts. The significance of a trend line may vary depending on the time frame used. Longer-term trend lines tend to have more relevance and attract greater attention from traders and investors. Trading with trend lines involves using them as a tool to make trading decisions and identify potential opportunities in the financial markets. Here are some common techniques and strategies for trading with trend lines. Trend line bounces. One approach is to look for price bounces off trend lines. In an uptrend, you can consider buying when the price touches or pulls back to the bullish trend line, expecting a continuation of the upward movement. Similarly, in a downtrend, you can consider selling or shorting when the price rallies to the bearish trend line, anticipating a continuation of the downward movement. Trend line breakouts. Trend line breakouts occur when the price breaks above a bearish trend line or below a bullish trend line. These breakouts can signal potential trend reversals or acceleration in the opposite direction. Traders often enter new positions or adjust existing positions based on trend line breakouts. Confirmation from other indicators or chart patterns can be used to validate the breakout. Multiple timeframe analysis. It can be beneficial to analyze trend lines on multiple timeframes. For example, you can draw trend lines on a higher timeframe, e.g., daily or weekly, to identify the primary trend, and then use trend lines on lower timeframes, e.g., hourly or 15-minute, to refine your entries and exits. Aligning the trend lines on different timeframes can provide a more comprehensive view of the market and increase the probability of successful trades. Trend line channels. Trend lines can also be used to define price channels. A price channel consists of two parallel trend lines, where the upper line acts as a resistance level and the lower line acts as a support level. Traders can look for trading opportunities when the price bounces between these trend lines. Buying near the lower trend line and selling near the upper trend line can be effective strategies in a trending market. Trend line slope. The slope of a trend line can provide additional information about the strength and momentum of the trend. Steeper trend lines indicate a stronger trend, while shallow or flat trend lines suggest a weaker trend. Traders can consider the slope of trend lines as a factor in their decision-making process, adjusting their trading strategies accordingly. Confirmation with indicators. Trend lines can be used in conjunction with other technical indicators to validate trading signals. For example, traders may use oscillators like the Relative Strength Index, RSI, or moving averages to confirm trend line bounces or breakouts. When multiple indicators align with a trend line signal, it can provide a higher level of confidence in the trade. As with any trading strategy, it is essential to manage risk properly by setting appropriate stop-loss orders and employing proper position sizing techniques. It's also important to remember that trend lines are not foolproof and can sometimes experience false breakouts or breakdowns. Therefore, it's recommended to combine trend lines with other technical analysis tools for a more comprehensive trading approach.